Hello and welcome to today's webinar. My name is Michele Weaver and I am the manager of the Homeowners Cafe. We are a free resource for clients and non-clients of ZionsBank, assisting through the process of buying, owning, and maintaining a home. Today, we're going to be covering what you need to know as a first-time home buyer. This webinar is being recorded and an archived version will be available within 72 hours. I will be taking questions at the end of the presentation as well as afterwards on Facebook and Twitter using hashtag ZDWebinar. So let's get started. The first item that we'll address are loan types. The loan types listed here are more standard options. These are the more typical loans that you'll see available at financing institutions. First, we have FHA. This is a government-insured loan that requires only a 3.5% down payment. This is a really attractive option for first-time homebuyers because not only does it require less money down, but that down payment can come from a gift, 401k loan, grant down payment assistance programs, or your own savings. Fannie Mae and Freddie Mac loans are typically what lenders are referring to when they talk about conventional loans. These loans require 5% of your own savings as a down payment. In this case, a 401k loan is actually considered your own savings, so that will work as 5% of your own funds. Fannie Mae and Freddie Mac are government-sponsored entities, so the insurance, the mortgage insurance that you would obtain in this situation would be from a third party. VA loans are loans insured by the Veterans Affairs Administration. These loans can be 100% financing and not require a down payment. However, in lieu of mortgage insurance, VA will charge a funding fee. There is no monthly mortgage insurance, but they do charge a funding fee. For rural areas in Utah and Idaho, 100% financing is also an option on this loan, and they also use the funding fee option. So let's get started and take a look at the following steps that are involved in the home buying process. Number one here, we have apply for a loan and get pre-approved. This is important because even if you think that you know what you can afford, you have great credit scores, you have some money down for a down payment, a real estate agent and a seller does not necessarily know that. It's hard to believe, but there's a lot of people out there you can't trust. So as a seller and an agent, you need to know that as a buyer you've taken that step to get pre-approved. You've shown the faith in your ability to get the financing to purchase the house you're looking at. Once you get pre-approved and you're a viable buyer, armed with the evidence of a pre-approval letter from your loan officer, you can then go out and shop for that home. Once you've got an accepted purchase contract, you'll want to let your loan officer know. You or your agent can send that contract to the loan officer or the loan processor. Now, depending how long it's been since you've gotten that pre-approval letter and that pre-approval, you may need to provide updated pay stubs and bank statements. So, as it says, submit updated documentation with your accepted purchase offer. That's what that's referring to. You want to be sure that your inspection is ordered and completed before your appraisal is done. Now, these things can be ordered at the same time. However, you do want to get the inspection completed before the appraiser comes out. I had some clients in my office that had their inspection done after the appraisal. They had a crack in their foundation and they had some issues with the roof. Fortunately, the crack in the foundation didn't affect the home at all, didn't affect the structure, and the seller did work with them on the roof. However, they had paid $500 out for their appraisal and could have been stuck with that had the seller not worked with them. Settlement of the loan is usually called closing, and that takes place at the title company. In order to get that pre-approval for your loan, your information will have to be reviewed by an underwriter. The underwriting decision is based on 3 components. Credit, your payment history, how well have you managed your credit, do you have any credit? Capacity, which is another way of saying how much debt do you have compared to how much money you make, and are you gainfully employed? And collateral. We want to be sure that the property is acceptable, and this refers to the appraisal of the property and the purchase price. So credit is anything that shows a payment pattern. Traditional credit is anything reported to the 3 credit bureaus. The 3 credit bureaus are Equifax, Experian, and TransUnion, and each of those 3 bureaus is required to give you a free credit report once a year. www.annualcreditreport.com is the only FTC-approved site, and I would recommend that that's where you go to get that report. None of the reports will come with a free credit score, but I always say if you manage your credit properly, the score will come naturally. Non-traditional credit things are things that are not reported to the credit bureau, but things that you're paying annual or monthly. So this can include insurance payments, cell phone bills, utilities, and in some case, if you're showing a savings history pattern on your bank statement, that can also be used as a credit item. In a moment, we'll take a look at a sample report from TransUnion, but what you'll find on that report is identifying information, so name, address, phone number, social security number, places that you've worked. Then it will have a list of accounts, and we'll go over these items: date open, last activity, payment history, credit limits, and then inquiries will also be listed on that report. Anytime anybody looks at your credit for any reason, even employment or insurance, that will show up on your credit report. So here's a copy of a sample credit report. You'll notice at the top the social security number, the personal information we talked about, date of birth, address, employer information. This particular report has a public record on it. A public record is anything that is recorded with the city, county, state, federal government. This could include tax liens, judgments. Occasionally, collection companies will record that information, and that will show up here in this public record. Account information, you'll see some key that will explain to you some of the items that we'll see later on the account. So the first account is Capital One. The account information is right underneath Capital One, a phone number, you can reach them. You have date opened. We have the balance is 0. If the pay is current. The last payment received was $114. The loan type is a credit card, and this account was closed by the consumer. Below that, you'll see a grid, and this shows the payment history. The third one over, you can see November 2007 shows 90. This means that this account was 90 days late in November of 2007. October was 60 days late. Negative information will stay on your credit report for 7 years, and positive will stay on for 10. This is a TransUnion report. Experian and Equifax are going to look different. And you are able to get a consumer copy anytime you apply for financing. And just to note that all of these reports will most likely look different, but they will all have similar information on them. Next, we'll talk about capacity. Capacity, as I said before, was job stability, your work history, income verification, and debt-to-income ratios. These are all things that are reviewed when we look at capacity of an aspect of the loan process. The loan types at the beginning all require a 2-year employment history. This does not necessarily need to be in the same line of work, but I would recommend double-checking with your loan officer. You will need to provide a month's worth of pay stubs. So if you're a teacher, you get paid once a month. That's going to be 1 pay stub. People who are paid twice a month, that's 2 pay stubs. You'll need to provide 2 years W-2s and tax returns, 2 years tax returns if you're self-employed, commissioned, or part owner of a business. Debt to income ratio is the amount of debt you have in ratio to your gross monthly income. We will go in depth in that a little bit more later. So monthly payment is referred to typically as PITI. This is going to be your principal, the amount of your payment that goes to your loan balance, interest, the cost of your loan, taxes. Property taxes in Utah are paid once a year. In Idaho, they're paid twice a year. And insurance. This is your monthly homeowner's insurance that's also paid once a year. Below that, you'll see some online calculators that you can go to that will allow you to kind of play with those numbers a little bit as you're looking into what your affordability is. I'm sure we've all heard about mortgage insurance. That's pretty common in the news right now. Mortgage insurance is not the same as homeowners insurance. This protects the lender in case you default. If you foreclose, you short sell, you don't make your payment for some reason, this is protecting the lender and the cost that requires to pay for a foreclosure. In a conventional loan, if you put 20% down, you will not have mortgage insurance. FHA loans will always have mortgage insurance, and they have an upfront premium as well as a monthly payment. As I said before, VA and USDA, they have an upfront funding fee, not mortgage insurance. So I promised a little bit more in-depth look at debt-to-income ratios. This will give you a pretty good idea on how our guideline works. In this example, we used a monthly income of $3,500 a month, and we also used the more lenient qualifying ratios of the FHA program. 29% can be dedicated to your house payment, and 41% can be dedicated to all of the debts that you have, including the house payment. Conventional loan guidelines are 28% to house payment and 36% to all the debt. So on the left, you'll see the $3,500 a month that this client makes multiplied by 29%, and it comes up with a house payment of $1,015. If you have no additional debt, this $1,015 could theoretically be dedicated to principal, interest, taxes, and insurance, the monthly payment. On the right, you'll see that he's got some debt. There's a car payment, credit card, student loans. So 41% of $3,500 a month is $1,435. But once you subtract out all the other debt, you'll see that $910 is actually the house payment, which is less than the 29%. So it's important to factor in all of the debts that you have when considering your home affordability. This is my favorite slide because I think it's very important that you consider what payment you feel comfortable with. A payment that fits into your budget is much more important than what your loan officer or your real estate agent think you can qualify for. It's more important to factor in, maybe you like to eat out more, so you've got to factor that into your budget and not make yourself house poor. How much money you put down determines your loan-to-value ratio. This is expressed as a percentage of the home value. We talked about 3.5% down for FHA or 5% down for conventional. This is because the lender will only lend based on a certain loan-to-value. We have a simple example here at the bottom. We have a $100,000 purchase price, $3,500 down, that's 3.5%. And it gives you $96,500 mortgage. This is 96.5% loan to value. I also said that FHA would allow for 3.5% down payment to come from a variety of different sources. A gift from a family member, a 401k loan. If you own an automobile free and clear, that's something that you could possibly get a loan on. That's your own asset. From down payment assistance programs or savings. There are several cities and counties in Utah and Idaho that have down payment assistance programs. You can find a list of those summaries on each program in the Homeowners Cafe website, but I do want to highlight a couple. The individual development account is a 3-to-1 match program. It's available both in Utah and Idaho. And if the home buyer saves $1,500, the individual development account will match that 3-to-1, giving the buyer $4,500. In the individual development account, that will actually allow you to open a small business, pay for student loans or go to school, as well as buy a house. Home Start is a grant that ZionsBank has the opportunity of administering through the Federal Home Loan Bank of Seattle. This is also a 3-to-1 match program. If you save $1,667, we'll give you $5,000. There are eligibility requirements on both of these programs, and Home Start is dedicated, obviously, just for homes. It's important to note that your loan officer, your processor, your real estate agent, they're only as good as you let them be. So if it's difficult to get information from you, it will be a difficult and arduous process. If you respond quickly and are cooperative, the financing will be more pleasant. It may still be a difficult process, but it will make it a lot easier. Here's a list of things that you may want to consider to bring into your loan application. Once you've submitted your purchase contract and updated information to your lender, the loan officer or the processor will order your appraisal report. These reports are ordered now through an appraisal management company. This is so that there's no conflict of interest. In the mortgage crisis, we saw a lot of loan officers and real estate agents pushing appraisers for high value on properties. I once saw an appraisal for $500,000, and when the property was looked at, it was a shack with no roof. So for that very reason, we want to make sure that there's no conflict of interest, and the appraisals are ordered through an appraisal management company. These are valid for 120 days, and we have a list of approved appraisers. So you will not be able to choose your appraiser. The cost of an appraisal is usually between $400 to $500, and an appraiser uses a cost approach, which calculates the cost of rebuilding the home, and a comparative analysis approach. This uses comparable sales usually within about a mile radius of the home, and this determines the value of the property. The reason that the appraisal is so important is that sometimes the sales price is not the same as the property value. If the property value comes in lower than the sales price, you would need to either renegotiate the contract or come up with the difference. Unfortunately, we've seen a lot of cases where that's happened. You know, you put in an offer for $200,000 and the appraisal comes back at $190,000, and your loan to value then becomes dependent on that $190,000. So you've either got to go back and renegotiate that with the seller, that $10,000, or bring that $10,000 in. There are several laws that protect you as a consumer. Fair lending laws protects your rights against discrimination in any of these categories: race, color, national origin, religion, sex, familiar status, disability. We also have the Unfair and Deceptive Practices Act, which was enacted recently. This fights against loan fraud. And I would say check with the Better Business Bureau and the National Mortgage Licensing System when you get your personal referrals. Definitely check all your documents before closing, know your rights, and educating yourself with the resources that you have available to you, such as this webinar, are going to help you avoid fraud. Here are some websites you can report to if you feel that you've been improperly treated. After you've applied for your loan with your loan officer, you will receive a package of loan disclosures. The good faith estimate is part of those loan disclosures. This form will outline fees and show you what your payment amount will be. The government has created this form to enable you to shop different lenders. However, it is a highly regulated form, so in order to get one, you have to complete a loan application and have your credit report pulled. Some people are not really comfortable with this. The loan officers at Zions provide a loan scenario worksheet that can give you an estimate of your fees before loan application. The Truth in Lending is another disclosure that helps you compare the cost of your loan. The top APR on this list is sometimes a little confusing. The annual percentage rate, also known as APR, is not the note rate on your loan. The note rate is the rate that your loan officer gives you. This APR rate takes into consideration fees or costs that are associated with the loan and expresses them in relation to the amount borrowed. A little easier way to think about this is your loan minus certain costs like underwriting, processing, administration, mortgage insurance, and then the interest rate is recalculated. So if your APR is a lot higher than your note rate, it means you're paying a lot in fees. Some of the other items on the form, you'll be able to see how much loan amount, so the amount financed, and the finance charge. So the total payments is going to be your finance charge plus your amount financed. Total number of payments, so that's going to be 30 years. That may show up as 360 months, 15 years, 180 months. A variable rate disclosure, if you are getting an adjustable rate mortgage or an ARM, that would be included in this form. A late charge, and if there's a prepayment penalty, that would also be on this form. Before closing, your lender will ask you to identify your choice of homeowners insurance. Sometimes you get a better deal by bundling, so you might want to check with your current insurance agent. And it's also a good idea to find out exactly what your policy will cover. I happen to live in Harriman on the side of a mountain, and when my home was flooded, it wasn't included in my insurance. However, if a pipe breaks in your home and it floods, or you leave the hose on, that is covered. So I guess what I'm saying is just make sure you check with your insurance company to make sure you know what's covered. Before closing, your loan officer or the title agent should get you your documents at least 24 hours prior to closing, so you have an opportunity to look those over, ask your loan officer some questions, make sure that things match up. It will also give you a chance to get your cashier's check prior to closing. Title company does not accept personal check or cash. They will accept a wire or a cashier's check. So this gives you an opportunity to get those funds in place. At the title company, your real estate agent is required by law to attend closing, and I would also ask that your loan officer attend as well. This gives you an opportunity to ask additional questions as you're going along through the process. The title agent, also known as the escrow officer, will usually do all the explaining and show you where to sign. You'll need to bring picture ID, and again, as I said before, a certified check is required for closing. Don't sign if you don't feel good about it. Go back to it's important if you don't feel comfortable. It's 30 years and it's 6 figures usually. So if you don't feel good about it, just walk away. So you'll have to sign a pretty good stack of papers. You'll get a hand cramp. But some critical documents are the HUD-1 settlement statement. This is going to show the actual charges, and you want to compare this statement with the good faith estimate to make sure that they're accurate. On the form, there's a side for the buyer and a side for the seller. Sometimes you will see both sides filled in, and sometimes the seller doesn't want you to know how much they got from the transaction, so it may be separate. The initial escrow statement will itemize your taxes and insurance premiums paid. The lead-based paint disclosure, if you have a home or you're purchasing a home built before 1978, you'll see this document for FHA loans only. On conventional loans, we don't have this disclosure. The first payment letter is pretty important because you would like to know where to make your first payment. However, be aware that this could actually change before you make your first payment. After closing and during servicing of your loan, you will get an annual escrow statement. This will be similar to the initial escrow statement. It'll show all the activity on your escrow account for the year. And by escrow account, I mean taxes, insurance, and mortgage insurance. If your loan is sold, the lender, the servicer that is servicing your loan has 10 days by law to send you a servicing transfer statement, giving you the information as to where your loan has been sold and who you will be making your payment to. In addition, you can ask for an amortization schedule. This will show you how much of your monthly payment goes towards principal and how much goes towards interest. In the beginning, you'll see on the statement that the majority of your payment will go towards interest and very little goes towards principal balance. Here's a graph that kind of shows that. The red is the interest. You can see this is a $200,000 loan. You can see that the first year, $13,000 of the payments goes towards interest. And down at the bottom on the right-hand side, the 30th year, you can see very little goes to interest and much, much more goes to principal. This is just an alternate view of the same type of thing. Different loan amount is $130,000. You can see in the first month, in the first year, $650 goes to interest, $129.42 goes to principal. And at the 29th year, $3.88 goes on the very last payment towards interest, and $775.20 will pay the loan off. So we've reached the end of our webinar, and we have a few minutes to address any questions. If anybody has any questions, please feel free to send them in now.
Okay, we've got a question. If you go with an FHA loan, you are required to have mortgage insurance even if you put 20% down.
That is correct. On any FHA loan, you will be required to have mortgage insurance. It does adjust a little down depending on whether you do a 15-year, 30-year, and how much money you put down, but you will be required to have mortgage insurance. For Jamie, we'll go ahead and put the last slide up. And we have a question to repeat the debt-to-income ratio information. For FHA loans, 29% of the gross monthly income can be dedicated towards the home payment, and 41% can be dedicated to all of the debt combined. For conventional, the ratios are 28 and 36%.
Okay, we've got a question from Andrew. What's the average price range for mortgage insurance?
That is going to vary depending on FHA versus conventional. If you would like to contact me after this webinar, I'd be happy to go over it with you.
Okay, question from Kim. If you apply for a loan and get pre-approved, does that show up on your credit history as taking out a loan?
No, until you actually have the financing in place, have the note signed and recorded in the county records, that does not show up as a loan. It will show up, however, as a credit inquiry. Okay. Thank you for all of the questions, and we hope this has been helpful for you. If you'd like to contact me for further information, I'm available at 801-316-1612, or you can email me at Michele, that's with one L, .weaver@zionsbank.com. You are also welcome to make a personal appointment with me, and thank you for joining us today.